This is something we decided to do because a lot of our clients were asking. We see a lot of issues as we're going through CFRs, so we're trying to kind of help everyone to get a better grip on things. And also a lot of our staff are on this too, so it's again giving some additional insight into our staff. So without further ado, Kelly's going to be joining me. Kelly Muir is a supervisor within our school audit and consulting practice. So Kelly, why don't you take it away?
All right. So here's an agenda of what we'll be covering today. We'll start with 11 practical steps that you can use to self-audit your CFR before you go and submit it. After that, we'll walk through the reimbursement methodology, how your rates are calculated, how surpluses and offsetting revenue work. We're going to particularly be focusing on CEIT and tuition-based programs. We'll also talk about the value of mid-year mock CFRs. We're going to review some key SED resources like the SEDFIN website and just show you how to access that. And then finally, we're going to touch on waivers and approvals. So this slide lays out a few steps that you can take to self-audit your own CFR before you submit it to your auditors and to SED. So first, before submission, the first thing you should always confirm is that your reporting period and the submission type are correct and in line with SED guidelines. From there, your CFR revenue, expenses, and net income should always be reconciled to your audited financial statements. You want to make sure that both reports are talking to each other and that they sync up. Number 3, you should also be reviewing all your costs against the reimbursable cost manual to identify anything that might be considered a non-allowable expense, and then make sure that you properly disallow it on the CFR.
And it's I was going to say, it's not just the CFR. It's not just the reimbursable cost manual, it's also CFR Appendix X. So when you're going through and you're looking at your allowable and non-allowable costs, Appendix X of the CFR outlines a lot of the non-allowable costs.
And then number 4, you should consider reconciling your FTEs that get reported on SED1 directly to the STAC reports, as well as your internal billing. A lot of SED desk audit questions that have been coming back are asking why the FTEs on SED1 don't tie to the STAC. So it's always good to have that reconciliation. Number 5 is always making sure that your allocation methodologies are clearly documented and consistent year over year, unless, of course, changes are warranted. So, for example, document your square footage allocations and how you're using square footage to allocate specific expense line items, maybe like repairs and maintenance, utilities, or telephone. And you also want to make sure that you're documenting your salary allocations. So, for example, if you allocate therapists based on, student-related service data, then you want to make sure that that's documented clearly in your internal policies. That way you have everything on record and it's consistent. Number 6, we always recommend that you perform a year-over-year review of specific and maybe major expense revenue or revenue line items. This might trigger questions that you might want to ask yourself, or maybe your auditors will ask later about why line items fluctuated so greatly year over year. Number 7, you want to review your agency administration costs on CFR 3 for completeness and reasonableness. Number 8, we're going to talk more about this in the later slides, but reviewing your staffing costs and hours in comparison to your classrooms or your units delivered. On SED4, you always want to make sure that that last column, which is your delivery percentage, it shouldn't be more than 100%. Sometimes if it is, that just means you have an error in a column on the schedule that comes prior to that last column.
I was going to say on that one, you're looking at if your percentage is, as Kelly mentioned, over 100, or if you have a really low percentage, that could mean something else is wrong, either from a staffing perspective, maybe you've got some of your related service staff charged to the wrong program. We've seen instances where a clinical coordinator, which is really the supervisor of the clinical staff, has been coded into the physical therapy, occupational therapy, speech therapy line when they should be carved out and moved to that clinical coordinator line. So again, it's just something to look at. If that percentage is over 100, as Kelly mentioned, or if that percentage is very low, those are things you're going to want to look at, especially also if that percentage is very low and you want to go for a waiver because the intensity of the children that you serve, and we'll talk about this more later, has greatly increased. What that last column on SED4 is, it looks at the productivity of your staff. And if that percentage is really low, that usually typifies that you have more staff than you need. And if that's the case, SED is not going to entertain a waiver for changes in intensity of the kids. So you really want to kind of pay attention to what's happening within some of the other schedules because they do have other implications with respect to what happens within your organization and your rates.
So then also on SED4, you always want to make sure that the FTEs in column 2A tie directly to CFR4 for each therapy PTC code. So this is listed specifically in Appendix AA where your auditors are actually required to check this. So if you have a 3.0 FTE for your speech therapist on SED4, we should be for program 9100, you should be able to go up to CFR4 and see that same 3.0 FTE for your speech therapist in 9100. And the same goes for the hours that are reported in column 2B for your contractors. They should sync up to what's on CFR 4A for your hours for each program and each therapist PTC code. And then lastly, just calculating your rates ahead of time allows you to maybe identify potential over under spending and make any final adjustments that you think may be warranted. So we're going to dig deeper into some tips for reviewing compensation and staffing reasonableness. So compensation and staffing are definitely some of the most heavily reviewed areas of the CFR. So when reviewing this section, you always want to confirm that the PTC codes are appropriate and consistent with Appendix R of the CFR manual. Also, one common issue that we sometimes see is that the PTC code 601 will have an FTE greater than a 1.0. You cannot have an FTE greater than a 1.0 for a 601, even during a transition year. So if it is a transition year, you'd have to code the piece of the 601 that's over the 1.0 to a different code, typically a 602, just to make sure that it's not reported on that line.
So basically so again, if what Kelly's talking about is if you are moving from a executive director or CEO who's going to be retiring and a new person's going to be taking their space, you really can only, under SED guidelines, only have one executive director. You can't have co-executive directors. You can only have one. So if you have more than one of them is your executive director. The other one is some other title within the organization, typically a 602 assistant executive director. So just make sure that as you're going through that transition, or if you are an organization, sometimes we also see somehow somebody worked a little bit of overtime and the way they track things in payroll is coming up to more than one. If you have more than one in that 601 code, SED will disallow anything over the one FTE.
Mm-hmm. And then your staffing should align with basically the services provided. So whether that's classrooms, care days, or units of service, you always want to make sure that the staffing makes sense with the units of service that you're delivering or the classrooms that you had open during that year. And we'll go through some examples of that on the next few slides. And then lastly, another simple but effective check is just to take the total salaries on CFR4 for a specific PTC code and divide it by the hours to see if the hourly rates make sense with what you're actually paying as the provider. So sometimes this can also highlight just potential mistakes in either the hours or the dollars that are maybe reported on CFR4.
I can't tell you how many times we do the calculation. We find out that organizations are paying teacher assistants $9 an hour or $11 an hour, which clearly doesn't make sense because it's below minimum wage. And then you realize that either the dollars are off or the hours are off. So just doing a quick analytical and doing some calculations, it really does help you to identify where something doesn't make sense within your the numbers that are in your CFR. And again, when things aren't right in the CFR, they could have a negative impact on your rates or on your reimbursement and can definitely generate questions on a desk audit.
Yep. Okay, so now we're going to go through some examples. So for example, if you have a tuition-based program that operates 4 classrooms, it's a 9100 program with a 12:1:1 ratio. This would require 4 teachers. So when you annualize that staffing based on the 46 weeks that the teachers work out of the 52 weeks in a year, you would expect that you would have approximately 3.540 FTEs reported on your CFR4. So in this example, you would see that we reported 3.750 FTEs for the position code 218, your teacher, on the CFR4. So that's fairly reasonable because you might have a little bit extra to cover coverages and absences that are taking place in those classrooms. a good rule of thumb, and it's not perfect, but typically if you're within a 10% variance, that's normally okay. But this is always a good check to kind of do with your FTEs just to make sure that you're reporting the correct teachers and TAs within the program based on the classrooms that you have open.
Also consider that if you do have floaters on staff or you do have substitutes, they do not go into the 218 line. There are separate lines for coverage staff, the floaters, and there are separate lines for substitute. So if you do put your substitutes and your floaters within your 218 line on desk audit, that'll be questioned and potentially disallowed by SED. So you do want to make sure that your 218 really just reflects the teachers that are in the classroom on a regular basis, the ones that were hired to be the big person in front of that classroom. Any other people who are in there kind of floating in for coverage when a teacher speaking to a parent or lunch coverage or any of that stuff is not flowing into that 218 line code.
Yeah. So for evaluations, which is program 9190 on the CFR, for reasonableness, we normally compare the total staffing hours to the total evaluations performed. So if you look here, we combine the employee hours that were reported on CFR 4, which is the 46,254 hours, with the contracted hours from CFR 4A, which is the 3,185. And you would divide that by the total evaluations that are reported on CFR 1, the 24,000. So that would result in approximately 2 hours per evaluation, which makes sense when you include some administrative time and write-ups that go along with the evaluation. So again, just making sure that things are reasonable before you go and submit your CFR.
Typically, most programs look at somewhere between 1.5 and 3 hours roughly for an evaluation. Obviously, some may take longer, some might take less. Some of the social histories take a little bit less. The psychological evals tend to take longer. So really, this is just for a rule of thumb. I mean, if you do this and you're coming up to, which we've seen happen, coming up to 5 or 6 hours for an eval, the question is, does that make sense? So really, a lot of this stuff that we're talking about today, a lot of the analyticals are really just kind of focused in on kind of what makes sense. And for those of you who can't do math, it's 4.
Okay, so for CEIT, units first have to be converted to half-hour units. In this case, they were providing half-hour units. So you would take the total units that were reported on the CFR of the 30,000 and divided by 2 to come up with how many hours were spent, which is the 15 hours when you convert the units to hours. And on the CFR, only 14,000 hours were reported. So this equates to approximately 1 hour per unit of service. And again, this is typically about 1 is in line with industry standard.
So if you do run into a situation, so in this case, you do 30,000 units, right? Divided by 2, that gives you units converted, as Kelly mentioned, to 15,000. So in order to provide those units, you need 15,000 hours of service. You only have 14. So even though this is close, as Kelly mentioned, to the 1, something's wrong here because I don't have enough staff to be able to provide the service that was provided. So typically, if this comes out to over 1, there's something wrong here and that you got to go back and kind of look at it. What you're typically looking for is something here within from 0.67 to 1. It depends. Some organizations do put in for their staff time for charting and all of that stuff. So that's why you'll come up to maybe about a 0.67. Anything lower than a 0.67, again, that usually means that there's something there doesn't make sense. Anything over than a 1 means that something clearly doesn't make sense because I couldn't have provided the services. So again, just something to keep in mind. You want to be in that, or you should be in that 0.67 to 1 range in terms of this calculation. Anything over 1, I just don't have enough staff.
Okay, so now reconciling your net income from your CFR to your financial statements, because your net income might not always be the same. So you want to make sure, again, that the 2 reports reconcile to each other. So if you're underspent within the 1% corridor, that would be something that you want to consider. That is income on the CFR, and it's income that you get to keep on the financial statements. If you're overspent within the tuition-based programs and it's not offset by any surplus, that would need to be subtracted from the CFR net income to tie to your financial statements. If you're hitting an indirect cost screen, that's not offset by a surplus, that would also need to be subtracted from your CFR net income to reconcile to your financials. You also want to make sure that you're adjusting for your disallowed costs, your prior period adjustments, and any tuition surplus from previous years that maybe you're using in the current year as an offset. We're going to talk more about surpluses in a few slides. You also want to add in your profit or loss from CEIT, your fee-based programs, your CFR2 other programs, and then make sure that you're also adjusting for your disallowed costs and any other revenue or expense reconciling items between the two reports. So it's always good to perform this reconciliation again before you submit everything.
The reason that this is important is when you go through and you look at things, you're already reconciling your revenue and your expenses within the CFR, right? There's a schedule that allows you to reconcile. But sometimes when you kind of go through and you do this reconciliation, you realize you might have missed an entry in your accounting records, or you realize that something doesn't make sense. So going through and doing this final little check helps you really to understand at all levels, at the revenue level, the expense level, and the bottom line profitability level, that all of the numbers kind of flow and they all make sense.
Okay, so this slide talks about the current reimbursement methodology. So for SED tuition-based programs, it's a cost-based reimbursement system that's subject to two screens. So the first is the non-direct care screen, which means that your indirect expenses are limited to 35% for tuition-based programs and 25% for CEIT. So you want to be below that threshold for your indirect costs, unless you have surplus to use, which we'll talk about. And the second screen is the total cost screen, which means that the provider is limited to the lesser of actual costs or the greater of prior year's trend adjusted rate or the current year's prospective rate. You will not be issued a reconciled rate if you spend within 1% of your prospective rate, then your prospective rate would just become your final rate. For 2025-2026, you can have up to an 8% reserve fund that can be retained and applied against future expenditures or to cover prior year losses within the program, as long as you're following the guidance. And then keep in mind that for CEIT, the funds are restricted for, if you're underspent, the funds are restricted for future CEIT expenditures, and they can't be used for any other purpose, which would include owner distributions.
That 8% reserve fund is going down to 5% next year, and it's going to continue to work its way down. So just keep in mind that your ability to establish these reserves, the last 3 years have been 11%. This year is 8, and like I said, it's going down to 5, and then I think 2 or 3 or 2. But the ability to establish these reserves is going away. So, if you've been relying on these reserves over the last couple of years to kind of bail you out on non-direct care screens and stuff like that, those are going to be going away. So, please make sure that you're working towards bringing your expenditures in line with where they should be.
And then this slide shows the difference between indirect and direct costs. So we have examples under both direct and indirect. The classification drives the non-direct care screen, so it is going to directly impact your reimbursement and if you're hitting that indirect cost screen. So anything that's directly used by the students, so food, supplies, the use of the playground or desks, that would all be considered direct. Obviously, the cost of your teachers and your teacher assistants who are physically in the classroom would also be direct. And then anything else is pretty much indirect. So your executive director, the rent that you pay for the classroom space, any repairs and maintenance costs, insurance, utilities. So it's important to understand what's direct versus indirect so that you can make sure that costs are properly classified and so that you can properly track your indirect care percentage and make sure that you're below the threshold.
I do want to remind people that if they do have questions, just raise your hand, and we're more than happy to kind of jump in and answer the questions. So when we look at kind of calculating your rate and how you go about the process of calculating a rate, so remember that it's important to understand, and as Kelly just mentioned on the previous slide, your direct costs and your indirect costs, or your non-direct costs, because remember, your non-direct costs cannot exceed 35% of your total costs. for any of your tuition-based programs and 25% of your total cost for CEIT-based programs. So again, you want to determine what your total direct costs are. You want to determine what your total indirect costs are to come up with your total program expenditures. The first step you do is you look to see if you're over on those indirect costs. In this case, in the example we had here, it's 28.57. So we're below that 35% threshold. If we had been above that 35% threshold, then we would have an indirect cost disallowance, and we disallow those indirect costs. Then you offset your disallowed costs, and then you also offset your offsetting revenue. Offsetting revenue represents any revenue that's coming in from other sources, such as, let's say, UPK in an integrated classroom, where you're providing both the disabled and typically functioning kids in the model. It could be if you're providing food and getting those food costs funded by CACFP. It could be a situation where you have interest income and you have working capital interest or other interests that you'd need to offset. It could be a reversal of expense from a prior year that you flowed through revenue. So there are a lot of different things that could generate, could be a grant. So a lot of other things that could generate offsetting revenue. So once you back all of those things out, you come down to your net cost. You divide your net cost by your care days, and you come up with a calculated rate. In this case, it's showing a calculated rate of $233.33. The way you calculate your care days is basically it's your student FTEs times 210 days if you're open all year round. When you look at that calculated rate, we're going to talk about the SEDFIN site a little bit later, which is where a lot of information is stored. One of the things that is stored on the SEDFIN site is the ability to go and see what the regional average rate is for your county. And it's important that you do understand the regional average rate, because if you are below that regional average rate, that might open up an opportunity. I'm not saying it will, and SED would shoot me if they heard me saying these words right now, but it might open up a possibility for a potential waiver that you might want to look at. CEIT, like I said, works basically the same way at the beginning, and then we'll get to the surplus component of it in a second. So again, direct costs, understanding your direct costs, understanding your non-direct care costs. In CEIT, as I said before, your indirect cost percentage cannot be above 25%. The reason that you have that differential of 25% for CEIT and 35% for tuition-based programs is that CEIT does not include real estate, because you really shouldn't have any rent or other property-related costs associated with CEIT, since CEIT is provided out in the community. So that's why there's a lower threshold for indirect costs for CEIT. Similarly, you back out your indirect cost screen if you have one. So if you're over 25%, you back that out. You back out any disallowed costs that you may have. And Kelly mentioned the disallowed costs earlier. Those are either from the reimbursable cost manual, or they're from Appendix X of the CFR claiming manual. You back out your offsetting revenue. Usually not a lot of offsetting revenue in CEIT. There could be, during COVID, there was a lot of offsetting revenue associated with funds or money that was funded by other governmental agencies, employee workforce funds and things like that. Come down to your net costs. You divide that by your delivered units of service. So it's not mandated, it's delivered unit of service. You come up to a calculated rate. In this case, it's $57.65. Your paid rate, if you're on Long Island or in New York City, would have been $62. CEIT works off a whole dollar calculation, so that $57.65 rolls up to a rate of 58. So if you're anywhere $57.50 and above, it rounds up. If you're below that 50 cents, it'll round down. So if this was 57.40, it would have rounded down to 57. So in this case, we've got a calculated rate of $57.65, which rounds up to 58. So if you look, we're overspent by $4.35, which works out to be $49,046. From a surplus perspective, like I said, you round up to the nearest dollar, so you're at 58 compared to 62. So there's a $4 differential. So the amount of the restricted CEIT surplus is $45,100. The other $3,946 in this calculation would be, in essence, that it would be money that you can use for any purpose. So you can kind of use that to cover anything else. The CEIT surplus, and we'll talk about this a little bit more later, but that CEIT surplus can be used to offset future CEIT over expenditures, or you can use it to offset tuition-based program over expenditures or non-direct care screens. I mentioned offsetting revenue. You can see here just some examples of it. So some of the participant fees, that would be typically within your 9160 program where you have your typically functioning kids in the classroom. You could have federal grants, any grant funds. So, to the extent that somebody else is paying for some of the costs that are included within that column, you have to offset the revenue. Things like federal grants, state grants. If somebody gave you a restricted contribution, hey, I'm going to give you $5,000, but that $5,000 has to be used for your 9100 program. That $5,000 is a restricted contribution. So that contribution would be considered offsetting revenue for purposes of the CFR. If you have a food program, I mentioned that would go on line, 82. If you have interest or dividend to the extent that there's interest expense, that would go on line 85. So there's different things you got to consider in terms of if you've got other revenue streams coming into the organization, you have to look to see, hey, did I include any of the costs that were funded by those other revenue streams within my CFR in these columns? And if so, I have to offset it. So one of the things that Kelly had mentioned earlier, she had mentioned the whole aspect of doing a mock CFR. And what a mock CFR is, basically it's doing what we refer to as mid-year planning. So if you have a tuition-based program, you have to make sure that you're spending that money correctly, right? Because if you don't spend that money correctly, you could wind up in a situation where either you're way overspending, and then where's that money going to come from to cover the cost of the program? Or you could be way underspending, let's say in excess of the surplus. And if that's the case, then that money is going to have to be returned to the county that's funding you in a 4410 environment, or the school district in an 853 environment. So it's really important to go through the process partway through the year to see what you're doing from an expenditure perspective. We do recommend that you do at least one mock CFR if you have a tuition-based program. We typically do for our clients, we'll do one in, let's say, January, February, covering the period through December, January. Some clients will do it again in April, where we look at expenditures through March, so that we can make sure that things are moving correctly. So basically what you do with respect to a mock CFR is you basically, in essence, you take all of your costs the same way you would do when you're doing a CFR. You project out those costs through the end of the year, looking at things such as, from a salary perspective, what's the salary on my last payroll? What staffing patterns am I short? Am I going to be needing to hire more staff between now and the end of the year? When I'm going to be hiring, how much is that going to cost me? So I can add that into my payroll. So maybe I'm short a teacher or short a teacher assistant. I'm down a therapist. I want to add those back in and project out through the end of the year. You're looking at fringes. Am I going to be making a pension contribution? What's the expectation of that pension contribution? Things like rent, you should know what your rent is. So whatever your rent was for the first half of the year is probably what your rent is going to be for the second half of the year, unless you're taking on more space or opening up more classrooms. So you got to go through and look at each one of your costs. And based upon those costs, you want to project them out to the end of the year. So you take your actual for the first 6 or 7 months or 9 months, you add on a projection for the balance of the year, both from a revenue and an expense perspective. So what I mean by that is, if you're let's say running a CEIT program, or you're running a tuition-based program, and you think you're going to bring on more kids, you want to add those additional fractional FTEs in through the end of the year. If I bring on more kids, am I going to be opening up a new classroom? If I'm going to be opening up a new classroom, when? Because I'm going to need to add another teacher. I'm going to add another teacher assistant. Every kid I add, I'm going to add more therapy services. So I got to consider that. Um, you know, in a CEIT environment, it's a little bit easier because if I'm going to be bringing on more kids, what percentage is my delivery rate? I usually average about 80% of the services of the mandated services delivered. So I take 80% of the services. I know what I'm paying each CEIT teacher. Let's say I'm paying $80 an hour. So it's $40 for every unit of service. And I can kind of add that to my expenses. So it's really going through and just projecting out what your expenditures are going to be, and then run them through the CFR model. Same thing we just talked about. What are my direct costs? What are my non-direct care costs? Am I hitting a screen? Am I not hitting a screen? Do I have any offsetting revenue? Do I have disallowed costs? What are my total costs? What's my projected care days based on the number of students that I'm working with? And then calculating out the rate and see how that rate compares to what you're getting paid, or what your max rate can be. That's really, really kind of, I know, a condensed version of what it is, but it's really important to do that because, again, it allows you to evaluate your spending trends within your tuition-based programs before the end of the year. And this gives you the ability to identify what you need to do to kind of put in corrective action. So again, do I have surpluses? If I do have surpluses, is that what I'm looking to do? Some programs might want surpluses because they need them in order to handle cash flow constraints and stuff. Am I overspending? Well, if I'm overspending, maybe that was my intention, but it's important to understand so you know what you need to do in order to kind of fix this. And it also helps you to kind of understand, because maybe when you're going through the process of putting together your initial budget or whatever, maybe you didn't realize that your medical expenses jumped 10%. Now all of a sudden that my medical expenses are 10% higher than I thought they were going to be. So now I have to kind of factor that in terms of, all right, if I'm going to spend 10% more on the medical expenses, where am I cutting somewhere else? It also helps you to start to go through that process so that when you get to that year-end audit, you can kind of streamline that process a lot faster. So by understanding kind of what people are doing and kind of going through all of that analysis on the mid-year level, you can start to identify maybe some of the mistakes or some of the issues that you weren't necessarily aware of. So things like maybe I have people allocated to the wrong buckets. Maybe I have someone listed as a integrated teacher when partway through the year, they moved into a self-contained classroom. So by going through this analysis partway through the year, you're actually starting to better define and produce better information so that when you get to that year-end process, it should go a lot quicker. Even things like putting together your RS data for the summer. Once the summer is over, you can start putting together that RS data. So you have all of that RS data together so that when you get into that year end and, we're bothering you for information for an audit, or your auditors are bothering you for information, which you shouldn't be using any other auditors than us, but bothering you for information, you really want to be in that position where that information, is available and you've kind of gotten it done throughout the year. And it'll also help you to see if some of that information doesn't make sense. Am I tracking this stuff wrong? So again, it provides for, early insight into program performance. It helps you to ensure that the information that you're pulling together is accurate so that you can make modifications midstream so that you're not kind of caught at the end of the year, kind of making these widespread journal entries to fix things. SED, OSC, nobody likes these final, last day journal entries to fix things. So the more you can kind of do it throughout the course of the year, the better you're going to be. And then also making sure that, you have a smoother year-end process for your sanity and ours. So let's talk about surplus. So what is a surplus? So back in fiscal 2023, which is the 22-23 year, SED released, it started with a New York State mandate, and then it came down through SED that basically said that a lot of the 4410 providers were complaining that they didn't have the resources to be able to run these programs. There was a lot of turnover, a lot of programs that were closing, probably between 2012 and 2021, 2022, about 25 to 30% of the agencies had closed down. I don't mean in terms of total classroom space, but in terms of the numbers of the programs. And a lot of that was just because from a fiscal perspective, organizations just did not have the fiscal wherewithal to continue to run some of these programs. So SED said, all right, through the mandate from New York State, SED said, we're going to allow organizations to hold on to certain reserve funds. So if you underspend, in the past, if you underspent, you had to return those funds and you'd see your rate go down. So what they said is, okay, what we're going to do is we're going to allow you to hold on to some of these funds, and we're going to add a provision in, which Kelly had mentioned earlier, where, when they come and develop your prospective rate, they don't just take your 2 years earlier and trend it forward and say that's your prospective rate. What they do is they take your 2 years earlier, trend it forward, say that's one aspect of your prospective rate, and then they take your prior year prospective rate and trend it forward, and they say whichever of the two is greater is the one you get. So that if you do underspend, that underspending is not going to affect your rates going forward, which is an important consideration, because who would want to underspend if their rates are going to go down? So SED kind of incorporated this to try to create some fiscal stability within the SED world. School districts were allowed to keep and have reserve funds. Everyone else is allowed to have reserve funds, but SED funded programs did not have that ability. So these surpluses are really there to create some fiscal strength within the organizations. So providers were allowed to maintain in 22, 23, 23, 24, and 24, 25, 11% surplus. That is not a cumulative 11%. Each year stands on its own. So at the end of 25, you could have more than an 11% surplus, because it's 3 years worth of surpluses. So if your operation stayed flat for that 3-year period of time, and you put away 11% each year, theoretically, you'd have a 33% surplus. So in 25, 26, that drops down to an 8% surplus. 26, 27 is 5, and then 27, 28, it drops down to 2. It ends in 27, 28 because that's when the new rate methodology is supposed to be ready and supposed to be available. So this is kind of providing some stability as we move into the new rate methodology, which is supposed to be, I believe that it's supposed to be unveiled a little bit this spring. So we maybe or should be hearing more about the rate methodology within the next few months in terms of where at least SED is with that rate methodology. CJ, you have a question?
Is the goal then, I feel like when we've talked in the past, it's always that we want to spend to our rate. But then with the surplus, isn't the goal actually to spend below your rate just to that percentage?
It's really up to each organization. All right. Every organization has to identify what they're trying to accomplish, right? I mean, from a spending perspective, if you have an organization that has reserve funds set up through other means, whether they're coming through contributions, coming through other programs that are create profitability. So remember, not every single program is an SED only program. They could be a different program. So in a program like that, they either want to spend to their rate or spend within that 1% corridor. And we'll talk about the 1% corridor a little bit later. If it's not on one of the slides, I'll bring it up anyway. So they're going to spend to within that 1% corridor because that helps to create profitability potentially for the organization. Because if I spend within that 1%, I get to keep that profit.
I think the
And there are
disconnect
other
then.
organizations that maybe need that cash flow. And if you're an organization that needs the cash flow, then yeah, maybe your strategy is I want to spend to within 7.5% or 7% so that I can keep that 7% surplus, hold on to it, and it provides me with kind of an interest-free loan.
Hmm.
that SED is providing you with that you can then utilize, for whatever you need it for, or you can invest it. And
Right.
SED has already said that investment income from the surplus is not offsetting revenue. So
Hmm.
that any investment income you generate from that again helps to build that surplus without, kind of an offset to other revenue that's coming in.
Great. And it's on a per program basis.
The surplus is calculated on a per program basis, but I can use that surplus, which we'll be talking
Right.
about now, within programs.
Okay. All right. Well, then I'm going to adjust my targets for what I'm trying to. It's just an interesting thing because it's a little bit confusing to me how you want to hit the higher of the three options for what your rate could be.
Well, remember, when you're dealing with
Hmm.
the surplus is only up to your prospective rate.
Hmm.
So again, this goes back to why somebody may not want to spend under their surplus. If I'm in a situation where my prospective rate, let's say, is going to be 250, but if
Hmm.
I take my prior year and trend it forward, it might be 253.
Hmm.
Okay, the surplus is built off the 250, not the
Got it.
253. So if
Okay.
I spend up to the 253, I get a rate of 253. If I spend within 7% of surplus, I'm only getting a 250 rate going forward.
Okay. Perfect.
So again, that might be another reason why somebody wants to hold off and not hold on to the money, but spend it all to get close to
Hmm.
that surplus, close
Great.
to
Thank
the
you.
actual rate.
Perfect. That makes sense. Thank you.
From a using surplus, so this is something that is relatively new. SED did come out with clarification. I don't want to say it's new methodology, it's clarification of the rules that were always in effect, but it just wasn't clear, maybe to me, maybe everybody else understood it, but I didn't. So from a clarification perspective, what SED basically said is that if you have a surplus and you generate a surplus in one of your programs, you can utilize that surplus to cover over expenditures, whether they be non-direct care screens or total cost screens in the same program that year or in a different program. So our understanding was always that it had to be in the same program, but no, it could be used in any program and can also be used to offset losses you have in CEIT. Just like CEIT surpluses can be used to offset losses you have in your tuition-based programs. So again, the interesting part about this is, you know, yes, I have a non-direct care screen of 35%, and that if I spend over that 35%, it becomes a non-allowable cost. But if I do have a surplus, either from a prior year or a surplus in the current year, I can use that surplus to hit the non-direct care screen and offset the non-direct care screen. So I can actually go past that 35% threshold if I have a surplus. Remember, this is only covering allowable costs. So if you have any non-allowable costs, such as meals for staff or lobbying costs through your dues to any of the membership organizations you belong to, or interest over acceptable levels, or excess staffing patterns, or any of those things that the SED considers to be non-allowable costs, you can't use surplus to offset non-allowable costs, but you can use surplus to cover allowable costs that have been screened out. So again, if you hit a non-direct care screen, you hit a total cost screen, you can use your surplus to offset those. Couple things to keep in mind. You do need to have board approval. So there needs to be a board approval that outlines the use of that surplus. Um, and again, that's for carrying the surplus forward. It is very difficult to carry a surplus back. There are some circumstances where you can carry a surplus back. Basically, the only way you can carry a surplus back is if you, in a previous year, due to losses, incurred debt. So I went out and I borrowed against my line of credit. I went out and took out a new loan, whatever it happens to be, but I incurred debt. And in the current year, I use some of that surplus to repay that debt. That is the only way that a surplus can be carried back. So it has to be debt originated by over expenditure within a program, and then the following year or in a subsequent year, there was a repayment of that debt. So it's a really narrow window of how you can kind of carry that back. So we've talked about the fact that, again, we can use surpluses for non-direct care screens, and we can offset non-direct care screens. And again, we can use surpluses to cover CEIT program losses, and CEIT surpluses can be used to offset tuition-based losses. One of the things that came up is, again, this is something that Kelly had mentioned earlier, that if you do have a CEIT surplus, that CEIT surplus can only be used to offset tuition-based or CEIT tuition-based losses, or carried forward for future tuition or CEIT over expenditures. You cannot use it to fund another program, not whether tuition-based or CEIT-based. Surpluses cannot be used for cost-based programs. You can't use it to cover losses in evals or in one-to-one aids or anything like that. You can't use it to fund EI losses. You can't use it to fund other losses you have within your organization. You can only use it for that narrow purpose. CEIT losses, CEIT surpluses, they're not considered, allowable for distribution. They are not discretionary funds. They must be used. They're kind of restricted funds. They must be used for CEIT expenditures going forward. So again, CEIT funds may be retained and not automatically recouped if unspent, right? So with any of these surpluses, you maintain them. They're not automatically recouped. CEIT expenditures, one of the reasons why CEIT is different from like your evals or your one-to-one aids, you look at it and say, well, look, there's a published rate. I have a published rate. Isn't this a fee-based program? It's not exactly a fee-based program. It still has its roots in costs, and SED's kind of distinction is that CEIT funds, again, as I said before, may be retained and are not automatically recouped if unspent. CEIT expenditures are auditable, so SED can come in, or someone else can come in, do an audit of your CEIT expenditures, and if there are CEIT expenses that are not appropriate, they can be recouped on audit. Unspent CEIT funds, again, may be used to cover allowable expenses and other SED funds, and CEIT funds may be used for SED fee-based. While they offer flexibility, CEIT funds, again, there are certain boundaries in how you can utilize them within the reimbursable cost manual. I know this has nothing to do with surpluses, but one of the things that did come up on a question with SED was that you actually can do retroactive raises. Bonuses must be paid within 2.5 months of the end of the year. So if you're a June 30th year end, bonuses must be paid by September 15th. But retroactive raises do not have that same limitation. So retroactive raises can be done after the fact. What the distinction that SED put in was that from a sorry, I'm just getting that off my screen. From a a retroactive raise perspective, it has to fit within your approved tuition rate. The costs have to be within the allowable screens and stuff like that. It has to be finalized before the certified rates are reconciled. So you can't go back and say, oh, you found this on desk audit, let me go back and give a retroactive raise. It really should be done before you file your CFR. And then it has to be fall within your normal guidelines, such as if you have salary guidelines, it needs to fall within those salary guidelines. It needs to be equivalent to all the other compensation decisions you're making within the organization. They need to be documented, and there needs to be governance oversight. I think we've kind of talked about this, that board approval is definitely required anytime you're dealing with surpluses, so we can kind of skip this. I mentioned, before I get into the kind of the SEDFIN website, I mentioned something before about the 1% corridor. I do want to spend a couple seconds talking about the 1% corridor. So SED allows that if you're, when you do your reconciliation, if you're within 1% of the published rate, above or below. So let's say your published rate is $250, right? 1% of $250 is $2.50. So if you're anywhere between $247.50 and $252.50, so somewhere within that range, SED will not reconcile your rate. So what basically SED will say is your rate is not reconciled. You're just going to continue to receive the prospective rate. So if you fall within 1% of that, your rate, your prospective rate, you're just going to get the prospective rate. You don't get reconciled. So again, if that's something that from a operational perspective, if you're within that 1% corridor, your rate isn't getting reconciled. So if you do fall in at 248, there's $2 per unit of service that even if you're underspent, you don't necessarily give that money back because you're within the 1% corridor. It was kind of SED's way of kind of eliminating some of the waivers that were in play. So let me talk a little bit about the SEDFIN website. This is kind of my best friend when it comes to SED. There's a lot of really good information here that and it's amazing how when we talk to some of our SED providers, they're not really as familiar with this website as they should be. So in here, you can see on the left-hand side, you've got rates and methodology, manuals and forms. Those are the two that I play with the most. Within rates and methodology, you can go in and you can look at your program. If you know other programs, you can look at any program you want, and you can look up what the current rates are. It goes back many, many years to see what the reconcile rates are, prospective rates, and everything else. So you can kind of get a feel for what's going on and see what's happening with your rates. You've got in here your one-to-one teacher aid rates. You got in here the regional weighted average per diems, which we use all the time when we're looking at executive comp. To see what the maximum executive comp can be in terms of, I'm sorry, that's the public median salaries, to see what the executive comp will be. The regional median weighted average per diems, if you go to the methodology letter, which is at the very bottom of there, and you go to the very back, there's a whole bunch of additional information at the back. And within there is the average salary for your self-contained classroom. There is no average daily rate for integrated. The integrated rate is usually a little bit lower than the self-contained classroom, but within there you'll have your self-contained classroom rates, which again then help you to identify, am I above the regional average? Am I below the regional average? If you're sitting with classroom ratios of 613, sorry, sitting with ratios of 613, you probably should be above the regional average rate. If you're sitting with ratios of 1211, you probably should be below the regional average rate. So the intensity of the kids that you're serving are really going to kind of help you to understand. The typical regional average is built off usually somewhere around an 812 rate. In here, you've got a bunch of other information too, your evaluation rates, your related service only rates, your CEIT rates, all that stuff is published here. Again, the methodology letter, that's where you can go in and see what the rate increases were from an annual basis. So that's really good. If you click on the manuals and forms page, within the manuals and forms page is where you'll find your reimbursable cost manual. That's where you'll find the most recent versions of the CFR claiming manual. Those should really be your Bible when you're kind of going through and dealing with SED. The reimbursable cost manual is important if you haven't read it. I know it's not the most fun reading in the world, but you should definitely go through it and read it at least once to kind of understand how the reimbursement rates work and what's allowable and what's not allowable. A couple of other things that you need to kind of consider. There are certain things that require SED approval before you can go and do them. So if you're entering into a new lease, you need to get SED approval for entering into a new lease. If you're going to be refinancing your debt, you need to get SED approval to refinance your debt. If you're going to have a capital outlay in excess of $100,000, again, you need SED approval for that capital project. We gave you a link for the guidelines. Please also understand that there's a new capital project guidelines that SED is reviewing. Those are expecting to be coming out soon from what we're hearing from SED. So there might be some clarification or some additional regulations surrounding this that might be happening within the next few months. But until then, the guidelines that are on that website that we've linked here should be what you should be using. Kind of at the tail end of listening to me drone on from a waivers perspective. Waivers are things that they're an ability for an organization to go back and ask SED for more money. SED is not big on waivers. Division of Budget definitely hates waivers, and they try to limit what those waivers are for. There are some places where waivers make sense, right? I mean, remember, they're not automatic, but if you have a change in classroom ratio, right? So let's say you have 4 classrooms that are 812s and 8 classrooms that are 1211s, and you want to convert 4 of your 1211s to 812s. Well, 812 is going to be more intensive. You have less students to average that teacher across and the teacher assistants. You have less students to average the cost of the classroom expense and everything else. So if you go through and you do some calculations, you could do a waiver to ask for a higher rate because the intensity of what you're working with in terms of the classrooms is different. So therefore, you need to get more money to service those kids. In addition, when you move from an 812 to a 1211 to an 812, a lot of those kids need more related services. A lot of those kids have more behavioral issues. So you might need more BCBA support or psychological support or whatever. If you have significant under-enrollment or mid-year enrollment changes that could impact your rates, that's again another place where a waiver makes sense. Some of those SED automatically puts in place. So if your average delivery, not delivery rate, I want to say occupancy rate, but I know that's not the right word. I'm just drawing a blank on the word. What?
Unit capacity.
Yeah, so you're basically, if you take your average of the students that you're serving in a classroom compared to what your total capacity is, and if that drops by more than 7% from your 2017, 18, 19 levels, SED will give you an automatic waiver for that. If you have a change in your student intensity, one of the things we always recommend is on an annual basis, just do a quick calculation. Go to your SED4, look at how many mandated services you had within a program, divide that by your care days, and compare that to last year, the year before that. And if you have an increase in that ratio, and you have an increase in the amount of related services that you're paying for, you might have an opportunity for a waiver because that just typically means that your kids are getting more intense, your kids need more services. Also, take a look at your staffing patterns on a regular basis. Did anything change? Did I have to hire a BCBA? Did I have to hire a psychologist? Did I have to hire certain staff members that the RA approves of? Because that could then give me a situation where I may have a waiver opportunity. There's not a lot of opportunities for waivers anymore. SED will not, let me say that one more time, will not give you a waiver for increases in rent. We've tried, they've said no. So, but there are certain places where there are opportunities for waivers, and you should go through and kind of take a look at some of that stuff in terms of analysis to see if if you are below the regional average and you can show that there's a reason why you're below the regional average, that might be a waiverable item. That's all we have. Does anybody have any questions? I know I went a minute or two over. Anybody?
I don't have a question, but I wanted to talk about something with STAC that I experienced.
Go ahead.
On desk audit, I always get questions of the differential in STAC, so it is important to reconcile throughout the year. And what I do find is some students that they STAC never attend our agency.
So I do get the reports from the file transfer, the SED file transfer, and it wasn't working properly. So someone at SED sent me only my agency's report so I could reconcile the stacks for 25, 26. And the other thing that I experienced was if a student is not attending the last week in June and you put an end date before the last day of school, the CSEs don't always change the stacks. So those FTEs come higher. So any changes that I make in June to if a student is less than a 1 point FTU, I email New York City and they restack them for me.
Thanks a lot, Jen.
So
Appreciate
I
your
could
insight.
send you the email address and the person that I contacted. It's very helpful.
Yeah, if you want to send it over, we'll push it out with the presentation. Thank you,
Sure.
Jen. Yeah, that's probably the most common issue we see on desk audit, where we have questions where the care days that are reflected within the CFR don't match out to the stacks. Any other questions, comments, sage wisdom, advice that anybody wants to give? We do appreciate everybody's attention. If there are other things that you'd like us to talk about in the future, we try to do this to provide insight to you, our clients, and you, our clients to be. So any information that you guys would like us to cover, we spend a big amount of time dealing with these SED issues. As new things come available, we will keep you guys informed as to what's happening. Again, if anybody needs CPE, please let us know. We will be sending out the slides from this. We'll be sending out the tape from this, so everybody should get all of that. If there are no other questions, thank you everybody for participating. We appreciate you all.